Welcome to the Support Automation Show, a podcast by Capacity. Join us for conversations with leaders in customer or employee support who are using technology to answer questions, automate processes, and build innovative solutions to any business challenge. I'm your host, Justin Schmidt. John Heck, good morning and welcome to the Support Automation Show.
Morning. How are you, Justin?
I am excellent. Where does this podcast find you?
I am in Charlotte, North Carolina.
Charlotte, North Carolina. Absolutely love the Carolinas. Have not spent time in Charlotte yet, but it's on my list. So this is going to be a special episode of the Support Automation Show. John and I work together at Capacity, and I've known John for a couple of years now. He has worked with us on a lot of the go-to-market strategies with our mortgage offerings and support automation. He has also introduced us to some of our bigger customers and clients, and is one of our thought leaders and, quite frankly, a preeminent thought leader overall in the mortgage tech space. So I wanted to have John on for this special episode to really talk about a lot of the trends and forward-looking aspects of support automation in the housing and mortgage space as we lead up to the big conference season in the mortgage space going into September and October. So with that, John, why don't you give us a little introduction on yourself and kind of how you got to where you are today?
Short vision is over 30 years in the mortgage space. Started off in sales, transitioned into operations, transitioned operations into Six Sigma. And then that was a perfect lead into automating operations, probably 15 years ago, maybe less. Transitioned into more of a data-centric focus, records management, what's done with the data that you're creating, kind of the dark data that all these companies have access to but don't use properly. Had a stint at IBM, became very in tune with artificial intelligence. At that time, Watson was being introduced into the financial services industry. I always looked at myself as an entrepreneur, kind of a strategic visionary within an organization. I was exposed to artificial intelligence and really became enamored with how data as a product can revolutionize financial services in general and more specifically mortgage. And I got connected through one of Capacity's board members, to David Carandish, the CEO of Capacity, a couple years ago. And I've been working as a senior advisor for Capacity ever since. I think the idea of an automated support platform, or another way of looking at it, in my vernacular, would be a federated data mesh, kind of an enterprise data solution, I think is the answer. And I love working with the culture of Capacity. Love working with the engineers of Capacity because they don't have any preemptive concepts about how to automate, how things have been automated in the mortgage space. They look at outcomes that, okay, this issue is X, let's solve it with Y. And that has been very intriguing for me, and love working with the engineers at Capacity. And I'm not patronizing anybody by saying that. It's really a great culture.
It is. And those engineers are extremely talented. It's one of my favorite parts about the culture here as well. So, John, every one of these interviews, after introductions, I ask the same question. And I'm going to ask you the same question I ask everyone else, and that is, when you hear the phrase support automation, what does that mean to you?
To me, succinctly, it's an enterprise data solution.
Yeah.
I mean, there's many machinations of that, but it's the ability to effectively use the data that I own as a customer in correlation with all the other technology initiatives that I have to operate within in the mortgage space, most of which are closed technology environments, which present, significant limitations.
Exactly. And related to a closed environment, at least conceptually, the computer science of this, I'm not accurately quoting here, but I think it's a good jumping off point for something we were talking about before we started recording. There's a lot of data in both in and outside of an organization, that can be used for decisioning, that can be used for business processes. That data comes in a lot of times in real time. Sometimes it comes in as batches. Sometimes it's the internal systems creating more data. Sometimes it's externalities bringing it in. Some of that data is sort of well understood. There is a often queried database of that data being sent to applications that are running processes all day. And some of it goes unnoticed, goes unused, or there's computational results of the data that are therefore data themselves, right? This concept of dark data and how it's not always sort of recognized and used. We were talking about this a little bit before we started recording, and you said specifically that it's something that you find interesting and see value. And I would love it if you could double click on that for me in terms of what is the type of dark data that you think goes most often underused in the mortgage space, and maybe what are some benefits of going down this path of exploration?
Again, conceptually, I think that there's too many intermediaries between where the origin of the data is and actually implementing the data into the manufacturing process. And most of the loan origination systems, if we're talking about the front end of the business, are binary in nature. They're waiting for things to happen so that the next event can happen. And the beauty of artificial intelligence is it replaces some degree of tacit knowledge. So I remember at one point, probably 4 or 5 years ago now, interviewing a CEO of then a non-QM company, and he was telling me that you cannot automate non-QM underwriting because of the complexity of it. And my response to him was, I could create 100 files and give those files to his senior underwriters, and there'd probably be a standard deviation of over 20% of reaction to those files, meaning that some would approve it, some would turn it down, some would condition it. And that therein lies the challenge for the mortgage industry. The wider the standard deviation of decision making, the more risk for the performance of that asset to the ultimate owner down the line. Artificial intelligence can be event driven. When the data is there, it's almost a series of simultaneous APIs where, and I use the term bingo logic or bingo decisioning. It's almost like the least complicated a mortgage application is, let's say it's 2 borrowers, salaried employees. There's 2 bingo cards. When the boxes on those bingo cards are filled, a decision can be rendered. Artificial intelligence, and by the way, the converse of that would be you've got 2 borrowers that are potentially not married, they're partners, and they're self-employed, and they have multiple investment scenarios. So it's a very complicated file to underwrite. But the difference is there'd just be more bingo cards, more boxes to fill. Artificial intelligence would know, based upon our knowledge base, what guidelines and rules that investor needs to look at those data points. And if the data meets guidelines, it's there, it's good, move on to the next. If it's inferior or if it's missing, it can actually send a message to somebody to get something done to fix that particular data. So it's not a linear, labor-driven process. It's an intuitive, tacit, AI-driven process where the system of intelligence knows what data has to appear in that particular box, let's call it, for that particular loan, for that particular investor. And there's a tremendously inordinate amount of reliance on seasoned people to make those decisions. And those senior people, 20, 25, 30 years of experience underwriting loans, is a very costly proposition. It's very, very cost prohibitive. So, I always ask people this question. We have the most sophisticated technology in the history of this world, and most recent statistics from the MBA last quarter, the cost to produce a loan is the highest in the history of mortgage banking. How do those two things go together? They don't. It's an oxymoron. We're not effectively using enterprise technology and allowing data to drive the events of manufacturing alone. The other component of this is there's way too much information and emphasis in automation and configuration on the actual manufacturing process, and not nearly enough on the outcome of the manufacturing process. So in other words, when the outcome has been achieved, that loan is ready to be decisioned. That's where AI and an automated support platform comes into fruition very, very quickly. It's ready to go. And it's not an assembly line where really easy loans are being slowed down because of the complicated loans that are in front of them on the assembly line. All of these things should be simultaneous, and
they should be parallel.
They should be running simultaneously in parallel, and there should be what I call exception processing. If there's something that somebody needs to interpret, then an individual can, and because of machine learning, now that system, the next time that nuance is presented, the machine learning has already reconfigured itself to know that that's no longer an exception. So again, the focus is having the data drive the process, and it's totally focused on the outcome versus the manufacturing process.
Right. And in maybe a somewhat more layman's approach and thought process here, if I'm a loan officer and the originator I'm working at has these types of systems in place, they are implementing the technology and processes behind what you just said. What is it that I, as a loan officer, am going to experience differently versus going to another originator that is still doing things more manually, more in series, having these big complicated loans clog up simpler ones behind it? What's the material difference I would see?
Well, I think we're in an age of what I call self-service. I think loan officers should provide to realtors and to consumers, to ultimate borrowers, some type of a module where the consumer can relinquish their data in a secure environment and, have it be able to basically frame up an overview of the transition that the borrower is looking for and give them, a realistic response like we've used the analogy many times with the IRS and TurboTax. The IRS is extremely complicated when it comes to whatever you put on a particular line item. It's very Boolean in that it creates other questions. There's no reason that mortgage companies can't operate in that fashion. So what I see happening over time is that self-service, people would prefer to be able to interact with technology on their own on to a particular point. And now when they want to talk with somebody that can provide some expert counseling, they've already got a preliminary idea of what they're looking for, potentially what the pricing may look like, what the variance or the range of the pricing might look like. And they're in control of the data that they release to that particular module because the consumer owns the data. Having somebody that is, Web 3.0 savvy and internet savvy to rely on somebody to do everything for me, I think that innovation, that train's left the station. I think people want to do a lot for themselves, and they want to pull somebody in when they want to pull somebody in, but they don't necessarily want somebody to drive the process. I think that's where the sales innovation is going to happen over time, because the cost of sales right now is extremely prohibitive. It's the most expensive part of the $10,000 it costs to produce a loan right now. There's got to be a better, more efficient way to do that. And I think that's where automated support platforms come in.
There is a growing feeling that one of these days I'm going to run a study to quantify this, but this is a hypothesis of mine. It's not necessarily a hot take, but I think I'm right on this. The expectation of experience that we have in our digital lives, that companies like Apple, Netflix, some of these other just beautiful, Amazon to a certain degree, that create these really beautiful, seamless, ultra low friction, exactly what you need, when you need it, how you need it experiences. The more we live our lives with an iPhone in our pocket and experiencing that kind of UX and setting those expectations, the more we expect that elsewhere in our lives. So it's the software we use at work. It's the going to the DMV and getting your license renewed. It's going through refinancing or getting a new mortgage, right? And it is incumbent on anybody who is making an experience in 2022 to make it as seamless and as fast and as convenient as possible. Because in a world of infinite choice that we live in right now, you're just not going to win unless you have that dialed for your user and for your consumer. One of the other trends that I see in the mortgage space, and you and I actually discussed, well, I didn't discuss it. I moderated a panel that you were on a month or so ago with the MBA talking about this with John Lebenick from Canopy. Lenders looking for new product lines to offer. So whether that be getting into non-QM or whatever it is, this is a great way for these lenders to diversify through the tumult that we're kind of all going through in the housing market. When you look at the most underserved, ripest opportunity for originators or servicers or just people, let's just say a mortgage business, the most underserved opportunity for diversification, what is it in your mind?
Well, I think over the years, Refi Mania has made the sales process to become it's a very easy proposition to basically enter information and to get a response back from one of the agencies, one of the Fannie Mae and Freddie Mac. I think one of the preemptive issues in non-QM is that there is not one standardized open environment that a lender can operate in with multiple non-QM investors. So in other words, with Fannie Mae or Freddie Mac, it's pretty similar with day one certainty and the loan quality platform that Freddie Mac has. They've really tried to standardize the way a loan is actually originated. In reference to non-QM, there's a lot of different machinations that lenders have to go through. And so many of them don't. They just don't want to offer the products because it's a different change in venue. And in many times, it creates a different manufacturing process. In some cases, there may be even multiple teams that operate with multiple investors. So I think an automated support platform, the beauty of it is it can actually standardize the entire QM non-GSE business. There's a lot of investors coming back now that are offering QM mortgages to compete with the agencies, but they're not offering it necessarily on the agency delivery platforms, as well as the non-QM products. So I think an automated support platform provides that. And I want to give deference to the back end of the system. As purchase money decreases significantly, as refinances decrease because rates are going up, HELOC mortgages are becoming more prevalent. Automated support platforms are a great way to offer those products. And then if you jump to the servicing end of it, which nobody seems to be focused on right now, we all assume that a servicer gets paid usually about 25 basis points for the ability to service our loans. And they can actually make money at that as long as all of us pay the mortgage.
Right.
As soon as we stop paying the mortgage and people start getting on the phone, when you're talking about 5 or 6 different phone calls with somebody that's 30 or 60 or 90 days late, you're talking about $500 or $600 worth of additional fees that are not covered in the normal servicing process. So as this economy becomes more challenging for U.S. homeowners, the bubble is going to switch from refi mania to default management. And there's no better way to keep costs low for a servicer than to provide a self-service solution.
100%.
In other words, I can go on, I can talk to a bot, the bot can answer my questions, I can actually upload data to the bot, the environment can look at that data, the automated support platform, like at Capacity, we can use intelligent document processing to extract data, to present that data to somebody that makes a credit decision. There's a tremendous opportunity in the servicing default management space for automated support platforms, because the traditional servicing platforms do not have the capability to operate outside of somebody paying their mortgage. That they're general ledger technology platforms, and both of the two leading market share providers are mainframe driven environments. They've been around for decades with GUI screens on top. So that there's a tremendous opportunity to be able to lean up the origination process for those that want to survive, because it'll be a survival of the fittest for sure, based upon profitability. HELOC focus, I think, is a really good place to put some emphasis. And then the default, if you are in the business of servicing your own assets or owning your assets, somebody servicing for you, having a default management solution now, knowing that the market may go south in the next 7 to 11 or 12 months, having one in place, I think, would be really critical for maintaining profitability.
That's exactly right. And one of the things that we're doing here at Capacity that I obviously am coming from a place of a bit of bias here, wearing my Capacity shirt and talking to you. But one of the things that we have worked very hard to do, and this is an aspect of our business that I believe puts us in a good position as a market leader, is we have built a really good system of intelligence and system of orchestration, for lack of a better word, on top of a lot of the existing tech inside a mortgage operation, whether it's on the origination or service side, and can help facilitate a lot of the data going back and forth, greasing the wheels on decisioning, offering self-support, all the stuff that you've touched on in the last few minutes. We're in a really good position to help make that a reality. And whether you're at Digital Mortgage, MBA Annual, you're at a TMC or Lenders One conference, we're going to be there this year. Stop by, talk to your account executive, give us a call, and do whatever you have to do to chat with us about this, because we really do have something that can help. And these conversations are ones that need to be had, because I'm sure the realization of these needs are going on at every lender right now. To your point about there's a potential default management boom coming. I think everyone would agree on that. You can only have inflation go so high and interest rates go so high, and housing prices being what they are. Like there's going to be some issues here, and you need to be prepared for the future.
Well, and to supplement that, I think the real critical issue in the mortgage space that I've seen, 3+ decades is that, and I'm stereotyping, and I apologize in advance for doing this, but in my opinion, the majority of people, they remain tactically focused and they don't get strategic. And now when, business is more difficult to operate, is the time to invest in strategic, visionary innovation. Because number one, when the market declines, the only way you're going to grow your business is redistribution from your competitors. And the only way to do that is to be able to operate in a more efficient, more profitable, more customer-centric way. And you cannot do that without significant automation. It's just not going to happen. If you look at the cost to produce a loan, again, we're talking about, anywhere from $9,500 to over $10,000 a loan. That rolls down to the closing table, and those costs eliminate a lot of potential borrowers and buyers of homes. And that's why so many people are renting right now. They just can't afford to buy a house. So we have to lower the costs. And the only way to lower the cost is through some type of an enterprise data-driven solution where, mortgage companies have to come to realize that their product is data. It's not the mortgage process. Data is their product, and the output of that data is an asset that they can sell. That's tantamount, I think, to the innovation focus that lenders need to make. And, the only way for mid-tier and smaller lenders to compete is to offer a similar scenario that the large lenders have. And that's the ability, they've spent millions and millions and millions of dollars on automation. The mid-tier and smaller have to kind of lease it and get the same output results. That's the way to stay competitive. I think companies like, Rocket Mortgage, they're a marketing company that happens to do mortgages. I mean, they spend a lot of money marketing their solution, for sure.
Exactly, they do. And while I'm always a fan of good marketing, there is a certain beauty to actual value and stuff that works, right? Which is what the industry is going to need, and what you and I both believe capacity provides. I want to close our conversation with a bit of a forward-looking segment here. And I'm really curious your thoughts on the sort of intermediate and maybe, let's think next few years and maybe next 10 plus, where the tech in mortgage worlds are going to continue to evolve and what the future of mortgage tech looks like. I know you are a very active learner and advocate of some of what Web3 is in the blockchain and some of the DeFi stuff that's happening. I'd love to get your take on how you see that adding value to the mortgage space, and then maybe a prediction for the future, looking out a little further ahead.
Yeah, that's pretty easy, actually. I think that the traditional mortgage industry focuses on automating the front end of the business. And I think we're at a point now, in the 1980s, technology was a massive change and innovator for the mortgage industry. And it came in dribs and drabs because, personal computers changed a lot of the ways that people did business, desktop computers. I think now, cryptocurrencies in general, people look at them, especially with all the recent media about the decline of these crypto platforms and, the concern about fraud and, some of the other things that are happening. I think capital markets in general, structured finance, is going to be the change agent that actually revolutionizes the front end of this business, because more and more institutional investors are getting into the non-GSE QM space and the non-QM space. And they're looking at it from a profitability standpoint. And when you tokenize an asset and you trade it and you have the ability to put it in a repository in the back end, you're eliminating all kinds of costs, fraud, speed. You're reducing speed. You have a better digital ledger of what's happened. You have a complete historical event of that asset. You can look at performance analytics down the road. So the structured finance part of this industry is going to be the innovation that affects rapid change over the next couple of years. And it'll never look back. If you don't transition into tokenization of assets and trading assets on digital platforms, you're just not going to survive because the economics won't work. Now, what's been lacking in cryptocurrency, which is desperately needed in the mortgage space, in the structured finance space, is regulatory governance. The cryptocurrency, they talk about it being self-governed, never going to work in financial services when you're talking about structured finance. There has to be governance and regulatory compliance issues that manage how things are transacted. And as those two meet, technology and the regulatory issues, then you'll see massive innovation happening, and you'll see cost reductions in how loans are being delivered. And the beauty of the non-agency loans is you're going to see things like assurance wrappers that basically cover anybody's losses if loans go through a particular manufacturing process. So the capital markets over the next 18 to 24 months are going to really create a significant change. And over the next 8 to 9 years thereafter, business will never be the way it's being done today. It'll change drastically.
Love it. John, it is always a treat and an educational journey for me talking to you about this stuff. And I really appreciate you taking time out of your day to join us on this special episode of the Support Automation Show. I'm going to end this conversation the same way I end them all, which is a few quick fire questions for you. So first thing that comes to your mind, what's the book that you most often recommend to people?
The Big Switch, from Edison to Google. I think it was Nicholas Carr wrote it. It's an older book, but I love following the evolution of change and how people were risk adverse and those that weren't affected massive innovation. I love that book. It's one of my favorite books.
It's a good one. It hasn't been recommended on this show yet before, so I always appreciate when I get a new one. Second one, what is your best tip, practice, trick, piece of software, whatever it is that you use to manage your productivity throughout the day?
Well, I'm going to change the question a little bit and
go for it.
And I'm going to relegate it more toward the industry. If I'm in the mortgage industry, whether I'm a servicer or a HELOC provider or a lender, I'm going to look at technology and figure out how it can become my infrastructure, my enterprise, where I own the data. It's in my data environment. And this enterprise technology that I'm using allows me to communicate with anything else that's out there. And whatever it's costing me, I'm getting a direct proportionate gain in ROI. In other words, if I'm spending $1 on technology, I'm getting $3 worth of ROI output. That has to be tantamount to any decision that a company makes when it comes to a technology provider. It has to bring value, measurable value.
Love it. Well, John, we're at time. I know you've got to run to another appointment, but thank you for coming on here and giving us your insights into the mortgage tech space and the future of the industry. As I said at the top, we're going to be at all the big shows this fall, everything from MBA Annual to Digital Mortgage to TMC, Lenders One. We'll be at all these places, and someone from our team will be there, and I am really excited for the prospects of our team meeting some great people at those shows. John, thank you so much for your time, and you have a wonderful day.
Appreciate it. Thank you.
The Support Automation Show is brought to you by Capacity. Visit capacity.com to find everything you need for automating support and business processes in one powerful platform. You can find the show by searching for Support Automation in your favorite podcast app. Please subscribe so you don't miss any future episodes. On behalf of the team here at Capacity, thanks for listening.